Yeah, well, it depends what you mean by recent, but if we're talking the last couple of years, rates have kind of been hovering in the sixes and sevens, which originally people I think were taking some time to get used to, and then as they have, people have decided, all right, fine, this is what's the new normal, and they've decided to just keep buying anyways. I think the higher price homes, they can hurt sometimes with those higher rates. But if you're talking more recently, as in the last couple months, we're actually seeing the lowest rates we've seen since the fall. So right now, FHA, VA are sitting in the mid fives, conventional low sixes, and that's pushing people back into the market who've been kind of waiting for the relief that everyone says has been coming. So in terms of what homes are being bought and sold, it's generally like the average price or maybe a little bit on the lower side has been more of the volume. But as we see the rates drop, we're going to see, I think, more people pushing their price points up and getting what they really want out of their home purchase. There are definitely people waiting on the sidelines right now. The projections are if we get about a 1% interest rate drop, we touch the fours, there's going to be just this massive flood of buyer demand surging back into the market. So, across the US, the predictions are about 1 million buyers sitting around waiting. So, if you want to be on the front end of that, I think you're going to get a lot more of the better deals. Right now, prices are softening, inventory is sitting longer, we're getting a ballooning amount of inventory on the market, really just catching us up to kind of the late 2010s in terms of inventory. But if you wait until everyone else rushes in, now you've got that increased demand, you're going to be competing with everyone else pushing those prices back up. So, the people are sitting around waiting. At the end of the day, I think you should be dating the rate, marry the house. You can always refi later. So it's a tough time right now to be a seller, just with so many buyers waiting on the sidelines for those rates to drop. What I've seen happening is you've got sellers' expectations caged too high. Affordability is the worst it's been in a couple decades, and things that could help that out are, wages go up, prices come down, interest rates go down. There hasn't been crazy fluctuations in home prices over the last year or so. Just, give that 6-month look back, see what other homes like yours have been selling for, price appropriately, and, don't do anything drastic. Like, understand that your home's not going to sell most likely in the 1 or 2 weeks that we saw during COVID. It's going to take a little bit longer, so plan for that. And we'll listen to market feedback and reprice as necessary, but making the drastic drops, I don't think is netting sellers the top dollar for their home. So just kind of the incremental, let's reprice to where we should be, but at the end of the day, it's still all about that initial pricing of the home. I'll probably advise people to list lower than they want to every time, just because you're going to drive more demand, get your home sold quicker, so you don't have those carrying costs. And then also, I've got a mentor who said you can never price a home too low, so it'll just get bid up to where it should be. Probably price a little under where you think it should be. You get enough interest, you get it sold around full price. Yeah, I know some lenders pushing people towards ARMs or adjustable rate mortgages, the lower rates. The expectation that over the next couple of years, rates are expected to get better, and so we can just refinance you to a fixed rate later. I mean, there's risk with that. So if you're comfortable with it, great. I haven't always seen the ARMs even pricing better than the fixed rate mortgages, so I don't like to push people towards ARMs, but that is an option. The other option, like you mentioned, is the temporary rate buydowns. And those are actually a pretty great deal because generally it costs less to receive the interest savings than the interest savings you get over that buy down period. So you can do 1-0, 1-1, 2-1, 3-2-1 buy downs, lower your interest rate for the first year, 2 or 3. You could take seller concessions and and pay for that. So I do like those options. And if you structure it right, there's two different ways to do it: lender paid, seller paid. If you go seller paid, that buy down that you maybe don't use because you refi in a year ends up getting applied towards your principal. So it's not lost money. If you can get the concessions, definitely I'd say crank up the concessions, get the temporary rate buy down. The other thing you do is permanent rate buy down, which I don't recommend right now because generally the expectation is rates going to get better and you permanently buy it down. There's a break even point. You don't have to wait 5 to 7 years before it makes sense for you to refi when rates are better enough to be worth it a year from now. You're going to have wasted money on a permanent rate buy down. And then the last thing is I've done about a dozen loan assumptions here in Colorado Springs. That's a great option if you're a vet, especially to use your VA entitlement and replace the sellers, take over their mortgage payment, their interest rate, remaining term, all that stuff. So, it takes a little longer to facilitate those, but fantastic option if you've got the gap funding available. Yeah, the Fed, if you look at the dot plot, that's where all the Fed board members put their expectations or thoughts on where they think rates should be over each quarter of the year. And you'll see that they think rates over the next year should be declining by about 0.5% over the next year, and maybe about 0.25% after that for the following year. By the end of 2027, which I know feels like a long time from now, the expectation is rates are going to be probably about 1% lower. If you're in a position to buy a home, I think you should do it now. And then in a year, it would probably make sense to do rate and term refinance. So you can skip 2 payments and then you lower your interest rate. Usually the break even is less than a year on the rate and term for the cost of doing so. I think that's a great way to go because then you don't have to compete with everybody who's going to be flooding in to purchase when the rates are dropping. So your purchase price is good, and then a year from now you get a good rate too. That's what I do on the buy side. For the sellers, I think the increase in demand is going to be met by an increase of supply. Because a lot of the people that are moving or buying are they need to move up or they need to move to a different city. They've been kind of holding off because they're in rate jail with the low interest rates. Generally means that pricing is probably going to be pretty flat. So don't expect your home to be selling for a lot more a year from now. Like if you need to sell now, sell now. If you're one of those folks who's going to be selling and then buying, I want you to be on that winning end of the buy side where you get the lower home price and the lower rate, as opposed to waiting a year. Your home sells for the same amount, and now you're competing with all the other buyers out there.